Hello and a very good morning everyone and welcome to FinTech Festival India. I'm Gitanjali Mathur, your host for the day, and today we are live from the city also known as the Queen of the Deccan, Pune, the 7th most populous city in India and the 2nd largest city in the state of Maharashtra. With an estimated population of 7.4 million, Pune has been ranked as the most livable city in India several times. Pune is widely regarded as the 2nd major IT hub of India and is also known as Oxford of the East, with the presence of a wide range of educational institutions within the city walls. Today, Pune has many large software and IT service companies. There is excellent talent availability. The city has an excellent year-round climate and quality of life. Compared to some of the bigger cities in India, Pune has consistently ranked among the top 5 cities in software and startups. As we end 2021, amidst the unprecedented pandemic that has gripped the world, the fintech market has continued to help expand access to financial services during the COVID-19 pandemic, particularly in emerging markets, with strong growth in all types of digital financial services. Surely, Pune has a huge role to play in this sector in the coming years. On that note, it is time to move on to our first session of the day, which is a panel discussion on accelerating digital lending with data and automation. This panel discussion is moderated by Mr. Apoorva Vaidya, Chief Business Officer, Finserv Markets, who is joined on this panel by Akshay Mehrotra, Member FACE, Co-founder and Chief Executive Officer, EarlySalary. Dr. Tarun Sharma, Senior Business Consultant, Nucleus Software, and Mr. Nishit Sharma, Chief Revenue Officer, BharatPe, who is also expected to join us in this session. However, due to some unforeseen circumstances, he could not be here. Nevertheless, we will make sure to have BharatPe be a part of future events. In the meantime, let us all welcome our panelists to FinTech Festival India.
So Akshay and Tarun, thanks for being here. It's a pleasure to be on this panel with you. If I look at the digital lending landscape, it has gone through certain dramatic changes in the last few years. The legacy processes and systems have been replaced by a lot of digital technologies, and the older systems have been disappearing pretty fast. What is powering the digital ecosystem in the financial services is data and automation. I remember, about 10 years back, borrowing was a big challenge. It was a very cumbersome process. Borrowers had to go to the bank, go through a very complicated, long paperwork-based process, and try to prove their creditworthiness as well. And creditworthiness itself, underwriting itself being a very complicated subject, it was pretty human dependent. A lot of human judgments were involved in that. It used to take, at times months to go and get a loan disbursed. Many of the banks actually lent only to their customers who were CASA customers, and perhaps the disbursements were made only to customers who were having salary accounts in their banks. Then came the NBFCs. These NBFCs had pretty smart, efficient, motivated people on the ground, and they had put up certain processes in terms of menu-driven systems, which made the whole process far more easier, automated the process to a certain extent, and the credits were disbursed, if not in weeks, perhaps in days, and in some of the cases in hours as well. This gave rise to the first consumer finance revolution in India. However, the entire process still remained very human intensive. Today, what we are witnessing is far more dramatic than what we have witnessed so far, and that is powered by digital. And the second revolution in the consumer financing space is what we are witnessing at this point in time, and all of us are party to that revolution. While in last about 18 months, this whole momentum has got a massive acceleration. It is not only COVID, perhaps, which has been the accelerator or the catalyst for this revolution. I think the digital journeys were started by most of the organizations in pre-COVID eras, but perhaps yes, COVID gave a great boost to this whole process. And we are seeing what we are seeing. One of the RBI data says that there's around 12-fold jump in the disbursements digitally, which amounts to about $1.4 trillion rupees in the time span of 2017 to 2020. Obviously, COVID and few other factors. What I wanted you to throw some light is what, apart from COVID, are the aspects which you believe contribute to the acceleration of digital?
So, I think let's look at the broader ecosystem, right? I think first was the payment ecosystem which came in, which meant that people got experience to payments via smartphones and exposure as a life beyond banks. The second came in is whenever money comes into picture, credit fuels the largest demand, credit fuels largest aspirations. I think what we noticed over the last 6 years of building EarlySalary, that as we build up speed to give money faster, I think we were the fastest lender 6 years back. We still maintain that part that today a consumer coming to us gets money in less than a minute. Right? That changed the ball game of way young people get used to banking transactions. Their experience to credit fuels larger aspirations, and fueling to that is the capability of lots of data connectivity which happen. I think first look at the way you onboard consumers today. There's access to CKYC, VKYC, access to DigiLockers, access to account aggregations, direct access to bank statements of people, access to a lot of organic data available which allows us to underwrite in a few seconds. In fact, when we started off, many people came and told us it's not possible to put a thesis out so you can lend in 10 minutes. I remember taking a flight all the way to Chennai and spending time with Tyagarajan, and he was one of the well-wishers to say, you kids, go out and do it. We are too traditional. We'll never be able to think that if a consumer needs money today, we tell him come after 3 months, we'll give it to you. You want to say if he needs it right now, we're going to be there.
Right.
Now today we look at use cases where we didn't ever thought that people will do things like that. Young people working in IT companies feel they need a salary increase, they want to do a skill upgradation. It's such an interesting use case. Someone who's a Java programmer wanting to do Python, it's a 100,000 rupee course. Can it be facilitated in the next 1 second? And that's what we're seeing today. 5,000 people a month opting for skill upgradation on simplistic platforms like ours. 85,000 consumers coming to a platform like us in runtime, borrowing close to $40 million a month. I think life is changing, acceleration is changing, it's all backed by data, it's backed by better analysis capability, it's also backed by the market being ready to do multiple more things and challenge banks in their own fraternity of catering to new to bank customers.
Wonderful. What do you think, Tarun?
I think the way I'd look at it first is from a data perspective. So the data that you shared, and I think it was evident in the report that was published on 18th of November by RBI that between 2017 and 2020, the digital transformation has actually, or digital lending has actually taken off. But if you look at it from a year-by-year perspective, then it's not that COVID was the tipping point. It sort of put digital lending on steroids. That's something that you could say. But the growth was always there. So in 2017, I think the total loans that were being processed by a digital channel for scheduled commercial bank was 1.5%, somewhere in that ballpark. By NBFCs, they were under 1%. They were just 0.69%. By 2019, which is, we can call it the pre-COVID year, financial year, the number in the banks had risen to 2.5%. But NBFCs had taken, leaps and bounds in that process, and their total onboarded loans were 23% of the total loans that they onboarded. So, the tipping point of getting to digital started much earlier. People started talking about digital lending, digital transformation. If you look at the consultant reports, this was being talked by 2010, 11, 12. But in India, I think with the advent of internet access into the hand of people, I think after the Geo moment happened, 400, 500 million more people added themselves to the internet platform. The amazing KYC infrastructure that is there, the data and the alternate data, and especially the tech-based firms who access that data and processed it into meaningful information that decision making could assist. That was something that was already simmering in the digital lending space. What happened in COVID, I personally feel, if you look at it from a law of diffusion of innovation curve perspective, I think 2019 was the time when the innovators in that curve were adopting as consumers the digital lending space. People who were more comfortable with operating onto digital platforms were actually doing that. What COVID did was it locked the next part of the population, which was, let's call them the early adopters and early majority, into a room, restricted their access to the physical space, and forced them to actually interact with financial institutions on the digital platform. And that's what sort of caused, if you look then, from 19 to 20, the scheduled commercial banks actually enhanced their digital lending from 2.5% to 5% of their total portfolio, which is huge in terms of the value that they would go. But NBFCs actually tripled in that time. From 20%, they went on to 60% of total loans being processed there. One other thing that I feel is that, this curve that has come up would lead to a consumer behavior which is going to be irreversible. The delta factor of convenience of interacting with a financial institution on a digital platform versus physical platform, to me, is very high. And especially, 65% of Indian population is under the age of 35 who are comfortable in onboarding themselves on digital devices. And what it may lead into is that by 2025, perhaps people would be more comfortable in relating a bank or a financial institution with a mobile app rather than relating it with a physical space. So I think that got accelerated by the COVID, but the fundamentals were already there. The digital lending was anyways increasing in that space.
Perfect. I think one more data point that I see is the financial transactions from 2018-19 to 2020-21, which have occurred from homes or from mobiles, have gone up from 29% to 76%.
Yeah.
I think I would personally attribute this to a lot to the digital savvy customers also, because see, it is not that the financial institutions were always providing the services and people were taking. It was more about their readiness to go and absorb those services and ask for such kind of services. Perhaps COVID did catalyze that particular mindset. But I think more and more customers are now wanting to, who are sitting on the fence, saying, should I do a financial transaction on phone or not? Perhaps are actually jumping into that and saying, okay, I'm comfortable doing this particular transaction in a far more digital mode rather than the conventional mode. I think wonderful part. But while internet penetration has gone up drastically, we are still seeing the bandwidths going up with 5G coming up. Perhaps we will have a game changer there. Then the mobile smartphone penetration roughly about 700 million plus, and the digital savvy customer. Where are we headed? What is the customer expecting, or what should the customer be expecting as we go ahead? Because once we ride over the COVID wave, because I believe that we do not require a COVID every time to go and give a boost to the financial system, because this is once in a century event, and we can't really depend on COVID to come and force us into innovating fundamentally. So where do the customers go from here? What do they expect? What should they expect as we go along?
So I think consumers are going to look at invisibility of financial assets, right? So the concept of embedded finance is the latest happening in technology, which means we are there, but we are invisible. I'll give you many use cases which we see today. Imagine you walk up to a hospital and typically your insurer had to put together a claim for you, and that hospital turned out to not to provide a cashless claim. Right? And suddenly you're in the middle of the hospital where your spouse is wondering, listen, I need to get the, let's say a stent put, and I'm in a medical emergency situation. I don't know where to run. My insurer says, I'm okay to give you money, but this hospital doesn't give you cashless. Now, embedded finance means someone has interconnected the hospital, the insurer, and a lending product to say, listen, don't worry, we'll make sure that we'll walk out, settle out the entire transaction. You just make sure the treatment starts. It's invisible, a part of your life. The entire transaction took less than 10 seconds to happen. It just needed one KYC of the patient or the person getting involved, the hospital doing an authentication OTP, the insurer doing an authentication OTP, and all of it got managed underneath. There was actually, if you look at, people ask what happened. So, and when you look at such invisibility of a credit instrument coming in, it's not like someone created a credit card, someone created a personal loan, someone created an option for a customer to fill up a form. It was all invisible. It happened. And it's actually started taking place. We're actually seeing that in almost 84 hospitals in the country, we're able to manage this transaction. Now, that is what is the new future of where financial instruments will become a part of your life. Your smartphones, or let's say, I'm not wearing my smart band, is your new credit card, right? Your capability of using NFC to make debit, credit, savings, all of it come together into one single instrument is the actual future. And consumers accepting that, right? A Gen Z customer who's just started to work in the last 3 years, once he experiences that, he's invisible to who is his financial provider. And to fuel this, another large wave which took place, and we are now seeing the regulator accepting that phase, which is saying who is the financial provider doesn't make the difference, who is the customer support partner is as important, right? And we are seeing the arrangement where, let's say if a bank wants to participate or a large financial NBFC wants to participate, it's coming true. Mechanisms of FinTech become the powerer of that transaction. We interact with the consumers, we make sure his journey is seamless. Who provides the capital and gives better leverage is a wholesale banking job. Yeah. And what happened in, let's say, large SME finance is now happening for a consumer who needs 5,000 rupees.
Right.
So it's the mass consumer getting catered in simplistic manner, bringing the OPEX down to levels where everyone can do transactions. And fundamentally, because you get invisible, you remove all the intermediaries who keep costing you large amounts of money, you bring the cost of finance down and people accept it. Today, if you can build in Indian market a transaction, let's say credit at 2%, remember credit at 2% for a new to bank customer was considered impossible. Globally, credit to new in, let's say, emerging markets operates at 200 to 800%. Here we're talking about unbelievable cost, we're talking about rationalization, we're talking about mass acceptance, and we have not seen growth rates like these. We have never seen, let's say, a 500,000 people coming to individual platforms each month asking for money. We haven't seen use cases which could be as various. I'm looking at the new ones that we announced last few months. Get married now, pay it in EMI. Right? Such a different way of thinking about marriage. Thinking about, listen, I like my child to learn a online, let's say, a upgrade or a what you call white hat course. I still can't afford the tablet, right? Can you help me pay per day? Making sure a grey collar employee who works as a delivery boy getting access to credit then cheaper than you and me what we pay on our credit cards. That's the future, right? And we are seeing that getting enabled on platforms, and we are seeing growth rates of almost doubling numbers every month happen, which I think which is getting fueled and demand getting created and consumers accepting those demands is the big part.
Pretty interesting. I think while you're putting consumer at the center of it, which is the fact, the aspiration of the FinTech players and the overall ecosystem. I'll come back to a couple of points on this one, in a short while. But Tarun, what do you think on how we are moving on this?
No, I think lending basically is a facilitator to an underlying wish that you would have. So lending would happen where the commerce is happening. So if you look at the demographic of Indian population, I just shared that 65% of our population is actually below 35. In fact, I think 50% of the population is below 25. And that's going to be the bankable population very soon, most of them. So the consumer behavior will continue to change. I was reading an extremely interesting fact that a millennial and a Gen Z customer would spend anywhere between 8 to 10 hours on their digital devices. And 20% of that time they would be using from their restrooms. So you are now talking about a generation who is going to apply for loans while getting themselves relieved. So from a consumer perspective, it's absolutely clear that digital platforms are going to be the way they're going to interact with you. On the lender side, I think channel of distribution is extremely important. But the nature of that channel of distribution would change. Today, financial institutions have their own channel of distribution where the customer would come in and apply for loan. Tomorrow, as it is shared that it's going to be embedded in the services that are being offered. You would be financing your phones from an Amazon or from a Flipkart and so on and so forth. So from a financial institution perspective, I think it's going to be extremely important to look at the channel, but also look at the capability that that the channel harnesses in terms of processing those applications really fast. And then the beauty that is coming up with the latest fintech is not just in the speed and the data and design. I think they're coming up with new business models. That's where the consumer, the responsibility with the industry would also be to inform and educate the customer on how can they in future interact with you. And I think that's where sort of we see the modern day fintechs and some of the new age NBFCs doing a brilliant job. I mean, if you have to think about getting loans against your salary or early salary, I mean, who the player in the market is.
Okay.
So, that would be perhaps our take, that, data and automation are going to continue, but we'll see new business models evolve as per the need of the consumer, who's going to continuously become more digital savvy.
Well, I think while the consumers are desiring more and more, the fintechs are becoming more and more enterprising in nature and in terms of the offering. I think there's one element in this whole, one cog in the wheel, which is really worried about everything the way it is going, and that's the regulators. Right? Let me switch to the discussion around the working group recommendations which RBI made recently. And a very interesting and scary data that comes out of that is there are about 1,100 unique apps that operate in India.
Yeah.
Out of these 1,100, roughly about 600 have been identified as illegal or pretty risky kind of situations, right? How do you see this whole industry and the momentum shifting or readjusting, recalibrating itself, considering the recommendations of the RBI working group around the data, because there is so much of access to so much of sensitive data. Then it comes to the cybersecurity part of it. So how do you see these recommendations that are coming up, that we all of us have gone through, perhaps trying to recalibrate the whole industry per se?
So I'm going to take you back 2 years. It was an interesting stage because most of the fintechs used to interact with each other.
Right.
I called it a WhatsApp group where at least the top 20 players where we interacted to discuss our sales numbers before each and every board meeting. We wanted competition numbers and we used to exchange on WhatsApp, and it was quite a good circuit, right? Because every board member needed what's happening. But when we saw lots of issues happening in the market, that WhatsApp group actually changed to set up what is today known as FACE, or FinTech Association of Consumer Empowerment. It's the first attempt by the industry to say we want to be self-regulated. We are actually asking the regulator give us an SRO status. We actually wrote to the regulator 18 months back with a list of 800 subprime, let's say Chinese-backed lenders who were charging upwards of 800%. And to our delight, the regulator enforcement directorate removed almost 780 of them.
Right.
It was the first time the industry got together and said, listen, we need to care about the consumer first, right? If we don't go and build trust, we are not going to grow.
Yeah.
Right. And the most interesting results took place there. The day those apps got, let's say, banned, the confidence in the industry grew by 17 times. Right? And I don't have to give industry example. Traffic to my own app went up by 17 times in 1 month. Right? Mm-hmm. It was not because apps disappeared. We were still ranked number one. We still continue to rank number one. Consumers stopped worrying about what's happening. Right? The second part is, as an industry, we put out guidelines for us, what is good and what is bad, what data is not needed by us. For example, we do not need access to your photo gallery. We don't want access to your contact book. We know how to run this business. The only difference between us and a bank is we are too small to regular to come and spend time on, which means the police is too less to manage us. Mm-hmm. Help us create another police so we get better regulated. It's a nascent industry. Any financial industry takes 10 years to mature. Technology has enabled us, let's say in 72 months, to become as large as the credit card industry. Right? Mm-hmm. Today, the top 10 fintechs in consumer lending have given more consumers access to credit than what credit cards did in 43 years, right? Which means that we are doing much more. We are able to influence more consumers, but we want the industry to get better regulated. Now, coming back to the guidelines, I think the first component, the regulator accepting that the fintech and digital lending is going to be the next large growth is clearly coming out. It's also clearing path that one day digital only banks will come in and they'll be full service providers and not just fintech lenders or fintech SME players or fintech payment players, etc., right? Which is a great horizon. The next, he said, function in the right manner and make sure that the grievances are well managed, OPEX are well managed. You are responsible for the singular most important function, which is risk underwriting. Yeah. Risk cannot be priced. You cannot charge more people. You need to be in control of your risk, and you need to be making sure that you can recover the money that you give out. Right. And that is the fundamentals of building a large FS business, right? And to me, I think the regulator has been the most swift. To me, I think RBI across the world regulators is the most forthcoming. I haven't seen a regulator across any of the other markets who wants innovation, at the same time wants newer ways of doing business to come in. And this is a clear sign that the next 6 months will clean up this industry, and I think in the next 6 months this industry will grow another at least 10 times. The estimations given all the reports should definitely be broken. It's about more consumer confidence, and I see that confidence come back, and I'm 100% sure that the fueling of the fintech industry has just started.
Just to add to that particular point, what you just said, does that also mean that it will create far better financial inclusion in the segments where people do not have access to such kind of finance?
Oh, absolutely. I'll give you an example for the largest employer in the country, Quest. So while we do lots of these cash loans on our app, we also managed to build this capability of working directly with employers. Now, we went to an employer whose average salary is less than 14,000 rupees, right? Not a single customer has ever borrowed from anyone, right, apart from an MFI. Interestingly, today we get 68,000 people who applied to get a salary advance, have built a monthly credit engine which gives them 5,000 rupees a month at 49 rupees charge. 49 rupees charge, no bank can even process a KYC, right? Here a digital lending instrument which runs perpetually for a customer, providing him a digital credit card experience, is available to the delivery boy of maybe a large e-commerce company who earns literally per day, right? And that industry is set up and running, and it's been demonstrated over consumer base after consumer base, and that is what is financial inclusion all about, right? If a first jobber comes to work in Bangalore, a classical private bank will say the day you complete 6 months, I'll give you money. Oh, if you work in Infosys, I can still think about it. But just imagine he works in a young startup, he's well paid, right? He must be earning 4-5 lakh rupees, but he can't even afford paying a house deposit, right? He can't even say, I can't, I come from a humble background, I need to fit in that culture, I need to look good, I need to wear particular clothes, I can't ask my parents anymore for money. But that is the support system which allow young people to get access to credit. And what's the most important part? 68% of the consumers that we attracted 3 years back, we have built their bureau scores. Scores went from NTC to 740 average. Salaries went from 25,000 to 43,000 rupees today. We did not lose them. They still continue to bank with us because they call up and say, listen, the traditional bank is an alien. They make me fill up a form, wait for 23 minutes to meet a person in branch. The digital banking practice says, I'll come to visit your house after you fill up the form, right? And you guys treat me like, I don't know what happened. It's a great experience, right? And as long as the experience and trust is built, both these parameters will fuel the largest amount of growth. Banking is built on trust. the regulator focus to build more trust is clearly coming in. And as these elements come in, businesses will grow to the next level. And I mentioned to you that there is, I think the next 24 months, the regulator will open up to say, listen, it's time to allow these young companies to become full-fledged digital banks. Let's open it up. Let's see what happened in US. We already have 2 of them. In LATAM, we have 6 of them. India will see a wave of many of these full-fledged banking entities meant for people under 30 so that they can cater to a very differentiated consumer base. Young segments which cannot be serviced, segments which have lower OPEX to manage business operations will see the sunlight coming in.
Okay, interesting. Tarun?
So I think first from a regulatory perspective, I couldn't agree more that if you read through the narrative that comes in the report, it's very clear that the primary stakeholder that RBI wants to take care of is the end customer. And if you look at how banking has traditionally been in the West, there is a concept of what you call responsible banking. That responsibility is not just towards your own books. The responsibility of a customer must take the product that they want by substantiating the reason that they want that particular product, and also making sure that those products that are given to them are the products that are tailored to their needs.
Right.
And when this goes into hardship, generally what would happen is that financial institutions would be the first one that would be asked questions by the regulator on why my citizen went into hardship. And I think with digital lending, and you took an example, consider, almost 40% of the apps that are either illegal or unregulated. If that causes, concerns to the end customer, it could lead into mass hysteria. The trust would completely go away and people would, refrain themselves in going to the digital bank. And I think that's what RBI really came forward and wanted to make sure. But at the same time, RBI also realized that there are pockets of business that digital lenders have been taking care of much better than traditional financial institutions. If you look at the tenure-based loan data, your private sector banks, 87% of the digital loans that they onboard are greater than 1 year. If you look at NBFC data, their largest contributor to the digital loans are less than 1 month. So, in ways, digital lenders definitely are catering to different segments. While catering to those different segments, they're empowering different customer segments to make sure that they get the financial inclusion and the products that they deserve. That would be my view from a regulator's perspective. From the future perspective, I'd just like to add that, I think when you look at the 3 categories that generally UK defines of digital banks, the front-end digital bank, which gets assistance from our financial institutions in the background, then your full-stack digital banks, which are, which are the true digital banks providing various services under their hood, and third is complementary digital banks, which one traditional institution like 811 or YONO in India would be there. I think in the next, 24 to 36 months, we would see good quality second category, digital banks full-fledged coming in, and they'll take financial inclusion to perhaps the next level, not just in consumer space, but also in the SME space.
Just taking a cue from here, see, we are still working with a lot of large banks as well, right? And I think the era of competition is getting a bit blurred. Perhaps it is more about collaboration within the ecosystem, whether it's a large bank, whether it's a merchant, whether it's an informal lender somewhere, because that's what even RBI is trying to fish them out. How do you see this collaboration taking shape going forward? What are the typical aspects that will play out in the next 12 to 24 months when it comes to collaborating with large banks and large financial institutions?
So I'm going to take 2 words here, right? So one side is the embedded finance, the other side is co-lending. Right? So I'll give an example. Today, the third largest NBFC, when you approach them for under 100,000 rupee loan, they just send the customer to us. They said, our OPEX capability is not possible to service this customer. You take it, right? And the customer doesn't know he moves. He sees a offer which pops up on his front end. He clicks on it. Our entire journey, let's say, which mirrors on Google Pay or which mirrors on some of the OEMs, runs there, and we are live and kicking in the entire process, right? he still gets the 1 second loan, right? And he gets the entire experience of borrowing, which he thought a traditional bank was not following. And we're now trying to work with banks and anyone who has a consumer where traditional players find it difficult and their OPEX is impossible to lend to, we'll provide the service. On the other hand, we actually walk up to people who have money at a lower cost and let's say, listen, we have a great customer. It's irrational to give him, let's say, money at 18%, right? He deserves money at 14%, but my OPEX doesn't allow it. Can I partner you? We'll figure out a way of partnering to give this customer a 14% money, yet give him a 1 second loan, yet maintain the customer together. And underneath a platform which gets created to say, listen, Akshay, I allow you to shop on Flipkart through me. I allow you to get a personal loan from another lending entity at 14%. I allow you to get instant short tenure credit which from another lender. You pay a single EMI. Your experience remains here, and we have 3 other players who are partnering as large financial institutions to power this engine, right? And it just allows a much superior leverage, and everyone is happy. Banks become the supplier of money because they control ownership of the cheaper cost of capital with savings. We become the front end to service consumer demand, and together we are servicing a much larger customer because of technology, because of lower OPEX and pure machine learning based data analytics capability.
Okay. Yeah.
So I think so India is extremely heterogeneous as a country. It was being said that this is a country where you get a Mercedes and a bull cart on the same road. So I think collaboration in terms of making sure that the economy reaches where it deserves and financial inclusion happens the way it happens is warranted. That's going to happen, and financial institutions realize what their strengths and non-strengths are, and the collaboration is going to continue there. What interesting that may happen after the 5 years when this transition goes through is going to be extremely interesting. When by 2025 or 30, it would be interesting to see that the largest institutions from a financial services perspective, would that be your banks or the modern day fintechs. And I think the way we are going, a lot of people are going to place big bets on the digital lender in whatever shape or capacity, a financial institution creating digital lending capabilities or a modern day digital lender. That's where the bets are going to be placed.
But one point coming back to what you said is, one is embedded finance and the other side. See, the point is digital only banks, right? While we envisage them to be here in a few years, are they not going to be a great threat to the traditional banks? And perhaps is it not that it will be disturbing the whole equilibrium within the economy?
Yes, so India is the most underpenetrated market when it comes to financial services, right? So if let's say we can cater to 10% of India, right?
Yeah.
And let's say by 2025, let's say 95% of it which was not served before. On the other hand, the wholesale banking component, which banks are really strong on, would be 95% of this, right? Which is the most important component. Efficient use of money is the most important principle of this business.
Right.
It is not that the cost of running business removes the efficiency. The collaboration between banks and new age companies is going to bring in that efficiency, and that is the future. Whenever you bring in those efficiencies, industry disrupts itself, and I believe that's the future for disruption.
And what is the time frame that you see for this?
I believe most of us are targeting 18 months here, and all of us have pressed the, I would say, version 3 of FinTech. I started my version of FinTech 3.0 5 months back, and we put up a goalpost saying that 24 months from now, can we become maybe $1 billion worth AUM, right? And that is a very tough task to taste, right? And it's not been seen. Fintechs have always been considered a velocity business, never an AUM business, right? But the way, the number of consumers we are servicing, we have done 2.5 million loans. We believe the next 12 months we'll do another 2 million loans. it's not possible unless we create this ecosystem of working with banks, working with consumers, working as embedded finance to solve all three solutions. And I'm pretty much sure the guys who started, let's say 36 months before or up to 5 years before, have the same intent. They believe they've created a right aura about them and they can pull off this structure.
Any closing remarks, Tarun, for you in this?
No, I think the future looks nothing less than exciting. The data automation is going to continue, riding the wave, helping FinTech and traditional institutions to, of course, grow. What's going to be really exciting is how the industry shapes in the next 2 to 5 years. And I would personally like to believe that, like I said, that financial institutions, people who are into that segment, who are smartphone savvy, are going to relate with financial institutions as more as an app on their phone rather than a physical building near their house or in the community.
Perfect. I think we'll wait for the future to get created, but the fact is future won't get created on its own. We will perhaps have to create and invent it.
Yeah.
Thank you for your time. Thanks a lot.
Thank you very much.
Absolutely insightful conversations. Thank you very much.
Thank you.
Thank you, everyone.
So thank you, Mr. Vaidya, and a big thanks to our panelists for sharing their insights on accelerating digital lending with data and automation.
और ट्रेडिंग शुरू? हाँ कर सकते हैं. नहीं कर सकते. लगी शर्त और हारा तो It's possible with CoinSwitch Kuber. Download करो और Bitcoin trading start करो. CoinSwitch Kuber. सिक्का चमकेगा.
Cryptocurrency is an unregulated digital asset, not a legal tender, and subject to market risks and price fluctuation risks.
Where there is life, there is hope, there is meaning. But life has its downs as much as its ups. Life is about challenges. Life is about opportunities. Time for joy, time for celebration, and time to introspect. Thankfully, in every one of life's moments, and even beyond life itself, there's LIC. Where there is life, there's always LIC. Zindagi ke saath bhi, zindagi ke baad bhi.
Welcome to Faygo, a pioneer in the world of intelligent open finance. With our full stack open finance platform, we enable companies to understand their users' financial behavior across various use cases, making finance engaging and actionable. Faygo's developer-friendly product stack helps clients with friction-free user onboarding and authentication using trusted account information. Connect and aggregate your users' banking transaction data from any source, either any of the account aggregators or directly from any core banking solution at flexible intervals. Enrich and categorize transaction data using machine learning algorithms to extract deep behavioral attributes of your users. Understand and act on real-time insights powered by your users' behavior for a variety of use cases ranging from lending, wealth, income verification, frauds, to even branding and marketing insights. Engage with your users by embedding our personal finance management SDK in your existing user-facing app to push positive financial habits and personalize financial insights to your users. If you are looking to engage or understand your user base's financial behavior to take informed decisions, Faygo is your perfect partner. With a complete Faygo suite, you can now capture what drives your users at every stage of their journey and use it to drive your growth. Plug into Faygo and let us do the heavy lifting for you.